Hey y'all, welcome back to another semi-retire with less series. What I'm going to do in this video is I had a comment or two that says I have no idea what you're talking about when it comes to, the retire with less series. So what I'm going to do is try to break it down a little bit in extremely simple terms. This video is going to be about cash secured puts, and I am not going to be advanced. So all you people that are Greek freaks like IV ranking and MACD and deltas and all that, theta, vega, I'm not talking about any of that. Okay. This is going to be bare bones, beginner friendly information on how a cash secured put works, right? I'm going to give you a few examples. None of these examples that I'm going to give are financial advice, nor is it a trade that I would suggest anybody to get into. Just disclaimer, FYI, I'm CYAing myself, okay? So without further ado, if you're new here, please like, share, subscribe, do all that good stuff. Down in the pinned comment below is Amazon link. If you haven't done Christmas shopping yet, you enjoy these videos, use my Amazon link. It doesn't cost you any more money to use that, and Amazon kicks back a small commission on every qualified purchase. So that would be awesome. Also, I just lost my train of thought. That's what's also. If you have questions, comments, concerns, leave them down below. I don't need any advanced option trade questions because I'm not the expert. Okay. But if you have some beginner questions about what I'm presenting in this video, leave them down below. And what I may do is gather up the questions, the comments, and do a reply video in this following week or so. So let me know down below. So here we go. Now, what I like to do, okay, what I would suggest most beginners do, it's just a suggestion, boy, I can't speak today, is to use ETFs, okay? You eliminate the single stock risk, right? Like if, some company, updates guidance and all of a sudden the stock plummets 30% in a day, right? You're going to avoid that, right? ETFs are a basket of stocks that if one gets wonky, it's not really going to move the needle so much. Okay. So one I like personally is IWM, and that ETF is the Russell 2000, right? Small cap. It's a huge ETF. I think it's got, it's the Russell 2000. I think it's got over 2,000 holdings. So not one holding represents over 1% of the fund. So, a handful of these could just go completely belly up, and it's really not going to move the needle on this ETF. Okay. So I'm going to show you what I look for in charting to establish my strike prices, what they call strike prices in options. Okay. And we'll talk about that. We'll go to the option chain. Okay. Now what I'm doing is looking at January 6th. And the reason why I'm doing that, it's going to give you roughly 30 days. Okay. I typically like to go 45 days, but let's just keep it month by month. Okay. And keep it simple. So when you go to, I'm on Fidelity, by the way, when you go into an option chain, okay, this is what you're going to see. You're going to see a whole bunch of numbers and prices and all this stuff, right? So if we're talking about cash secured puts, right, you got one side here is the call. So you split this graphic in half. One side is the call side. One side is the put side. Today we're going to concentrate on the put side. Now, what is a put? A put is if you were to sell a cash secured put, this is important, not buy one, sell one. What you're saying is you are promising to buy this security, in this instance, IWM, at whatever strike price you choose. Okay. That's below the current share price. So the current share price is 178.62, and you can go down, let's say $170. So you're willing to buy. What this means is you're willing to buy 100 shares at $170, and for that promise, you will be paid between the bid and the ask price, typically, right? This is someone's wanting to buy, someone's wanting to sell, and there's a spread there. So $1.90 to $1.95. Let's just say you get that in the middle. Say you get $1.92. So that's $1.92 per share. Each contract represents 100 shares. So that's $192 that you will be paid for the promise that you would buy IWM if in 28 days it becomes IWM trades at 170 or below. Okay, that's it. That's the anatomy of a cash secured put. It's that simple. Okay. Now, how do I choose the strike price? I like to do charting. I don't get into it extremely deep. Like you can take charting and go hog wild with all kinds of indicators and all that stuff. I like to use a simple indicator, and that's support and resistance. That's it. So let's look at the chart. And on Fidelity, now I don't know how this looks on other brokerages, right? But they should have some sort of charting feature where you can set this up. Okay, so on Fidelity, what you do is you type in your ticker symbol, and then you go to Chart Plus. And what that does is bring you to this chart. Now, I already have this set up, but just for you guys, if you're in Fidelity, you go to Events, and you go Support and Resistance. Okay, you just click on that. Now you can set a timeline, trading horizon, 250 days, 500, 100. I typically keep it on 250, and you hit apply. Okay. These other lines are just moving averages. Don't pay attention to that at this moment. But what you'll see here is the green line is support, and the blue line is resistance. Now, resistance comes into play on the call side. So this on the put side, this kind of is irrelevant. So what I like to do is look at where the support is, right? It's right around it'll say right here on the side, 168.90. So if you are bullish, right, you want to be around that. Right? If you want to be safe, be around the 165 level, below that support. If you want to be somewhat aggressive, you don't mind owning shares if it gets to that point. This typically represents a decent entry point, right? Technically. So let's call it 170. Okay. We go to the option chain. What do you get? Like we said, $192 for the promise to buy 100 shares by January 6th or 28 days if IWM reaches $170 or below by that date. Okay. Hope that makes sense. Now, another one, if we're going to do single stocks, right? We'll talk about single stocks. I know I said I would recommend starting with ETFs, but if you're going to do single stocks, I would suggest doing it on big companies. Okay. That's just me. Don't chase these meme type stocks, right? Like the GameStops, the AMCs, the all that stuff, right? Do it on big companies that are strong, such as Google, right? Here I got Google. Now, what do I do for something like Google, like a single stock? One thing I do, now this is going to probably draw some controversy. I check to see when earnings are. Right now, there's no earnings. I don't know why it's not in here. I might not be logged in, but I check for earnings. Okay. Now, if earnings were within today's date through the expiration of the put that I'm selling, I will not sell that put. Okay. I do not play earnings ever. Okay. Now, people are going to argue, and they're actually correct, that you can get more premium. You can get paid more if you sell them during earnings. This is true, but it's a double-edged sword. The reason why you're getting paid more is there's more risk. Okay. So that's one thing I look at. I look at the earnings date. If it's, not within the time frame of the contract I'm trying to sell, I go for it. And then we'll look at the Chart Plus on Google. And same thing. Let's look at the events. Let's look at the support and resistance there. And the support is right at $86. So if you wanted to be somewhat aggressive, you can go with the 85 strike, right? If you wanted to be pretty safe, you can go down to the 80 strike. What will that get you? Well, let's look at the option chain. Same thing, January 6th, 28 days. Google, we go to the 85. You'll get paid roughly 94 cents to sell to open that put at $85. So you'll need $8,500 to secure the promise to buy. Okay. But you will receive $94 deposited in your account. Next example, Amazon. I'll do the same thing. I'll check for earnings right now. Amazon to announce quarter four earnings February 1st. So we're looking at what, January 6th? So earnings aren't there. So we're good. So we'll go to Chart Plus. We'll scroll down. We'll do the support and resistance again. And we'll see support, it's sitting on it, right? Right at $88.04. So I would probably want to go down a couple more dollars and call it 85. So I would sell, a matter of fact, I think I have one on right now at $85 personally. So we'll look at the option chain, go to January 6th again, and $85, you'd get about $2.32. Whoops, messed that one up. I'm not logged in, that's why. You'll get about $2.32. Why? Because you're closer to the strike or the current share price. So it only needs to drop $4 for you to be assigned that. Okay. But you'll have to have $8,500 in cash to secure this. And you will receive $232 in cash deposited in your account. That is yours to keep. Okay. So I hope that kind of explains what a cash secure put is. Essentially, it is a promise to buy at a certain date at a certain price. And for that promise, you will get paid a premium and you get to keep that premium. So let's take a look real quick at what the returns are for that, right? Like we looked at IWM. We did a strike price of 170. We said we were going to get about $1.93 in premium. So you'll need 17,000 in collateral, which is $170 times 100, right? You collected $1.93. That's per share. So that's each contract is 100 shares. So you collected $193. So that's a 1.14% return on your money, return on your 17,000 in 28 days. Annualized, that's roughly 13.62%. Might be a little higher because, like I said, this was 28 days. So this is just this times 12. So 13% annualized return. Not a bad return. Now just think, if IWM never got the 170, you keep this cash. Nothing happens. Okay. You can do this all over again the next month and keep doing it. What that would mean is you would never own IWM. You would just continue to collect your premium if it never reaches your strike price. Okay. The next one we talked about was Google, right? You needed 80. We went to 85 strike. We needed $8,500 to secure it. We collected 94 cents times 100, so $94. That one, 1.1% annualized monthly return, 13.27% annualized. Now the big one is Amazon. Same 8,500 that it took for Google, but since Amazon is trading a little bit lower, and would have to drop a little less further for you to have to buy these shares, you'll get paid more. Plus, there's the IV rank people are gonna chime in here. The reason why the premium is more. Now that's a little more advanced. We're not talking about that, but basically, you're closer to the strike price. Okay, the current share price is closer to the strike price. That's going to get you more money. So in this case, it gets you $2.32. Times that by 100 shares, you collected $232 for your 8,500 in collateral on Amazon, which a monthly return is 2.73%, annualized at 32.75%. Now, you can do this month after month as long as your strike doesn't get breached. You can continue to collect this month after month, right? Now, of course, if it reaches 85 or below, you'll have to buy 100 shares at 85. Even if it dropped to 80, you'd still have to pay $85 a share for Amazon, okay? There's no fixing that. That's just the way it is. But you can turn around and start selling covered calls, and that is going to be the subject of next week's video, most likely, or whenever I feel like putting it out. Just FYI, I may not be doing Saturday videos anymore. It may just be random, right? I'm kind of not liking the schedule of every Saturday religiously. I kind of want to leave it kind of flowy and just let it fall where they may. That's not a guarantee that I'm not going to do Saturdays anymore. I'm going to try to do them, but if it's stressing me out to get a video out on Saturday, then I'm not going to stress about it. Hope that makes sense. So there we have it. Cash secured puts, a few examples. Basically it's a promise to buy, right? And for that promise to buy, at a certain time, at a certain price, you get paid a certain amount of premium that you get to keep, right? That you don't lose that. Now, tax people are going to say, oh, it's short-term gains. Yes, they are short-term capital gains. Okay. Qualify or ordinary income, however you want to call it. So that's it. If you guys got any questions, leave them down below. I will try and make a video because I have a feeling there's going to be some visuals that are going to be needed to answer some of the comments that are questions, concerns that we have from this video. So hopefully I covered it, as simply as possible. That was my goal, is to cover this as simply as possible for the people that have no idea what a cash secured put is, or stumble across the retire with less series and go, what the heck is he talking about? That's what this is, the purpose of this is. So again, Amazon link down below. If you enjoyed, you want to support me, I'd appreciate that. Like, share, subscribe, leave them comments, questions, and we'll try to get back to them within this week or coming up or so. So hope you enjoyed. Have a good one. We'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.